the thing I think a lot of people have to realize is that with diversification, you're smoothing out the risk, but you're also smoothing out the returns. And so a lot of people, they don't like diversification because when they hear the word diversification, they think, I'm not going to make a ton of money. And it's true. I mean, you're not going to hit that home run where you make 1,000 times your money when you're diversified, because there may be a couple deals that you do really well on. But if you're well diversified, you're probably going to have a bunch of deals at the bottom that you don't do well on. It kind of smooths that out as well.
Welcome to the Bar Down Investing Show. Here are your hosts, Kyle Wilson and Jay Scott.
Hey there, and welcome to another episode of the Bar Down Investing Show. I'm your host, Kyle, also known as Ashley Wilson's husband. I'm once again joined by Mr. Jay Scott. How's it going, Jay?
I am doing great. I'm excited about today's episode, especially because it's already been recorded and I don't have to do anything except this intro.
Yeah, we got another drunk real estate episode coming at you. I know this is the one that everyone looks forward to. So who do we have for guests this week?
Yeah, so we recorded this one a month or two ago in Philadelphia, Pennsylvania, your hometown. At
Go Birds.
What was the name of the bar?
So it was at Guppy's. So that was one of my old stomping ground bars.
Yeah, so if you're in the suburbs of Philly, go visit Guppy's. Tell them we sent you. We have a really good discussion today with two amazing investors. Number one, MC Laubscher. So for those that don't know MC, he is the Cashflow Ninja. So he runs a whole bunch of podcasts, but his main podcast is Cashflow Ninja. If you haven't listened to it, absolutely listen to it. He doesn't just talk about real estate. He talks about all things investing, economics, insurance, and just has a great perspective on a whole host of topics. And secondarily, but just as importantly, we talked to Anil Dham. And Anil is a developer in the Philadelphia suburbs, an amazing investor as well. And these guys are just so knowledgeable. What did we talk about on this episode?
Yeah, it was great because you mentioned that MC has a podcast where he talks about such a large swath of things. So we touched on diversification, how important it is in your portfolio, and how people typically look at diversification just in the stock market. I'm going to have this stock, that stock. I'm going to diversify, but outside of the stock market, being real estate investors. And Anil had some great tips about bankers. And we talked about shifting. We have a real change going on in real estate and the economy and everything, and how people might be shifting what they're doing and what to look out for. So, it was a great discussion.
Yeah, and at one point during this conversation, MC goes off on I don't want to call it a rant, but a great discussion about risk and how a lot of people perceive risk in certain ways. And while it's important that we perceive risk in certain ways, there are lots of ways we're not looking at risk and that we should be, because there are lots of risks out there that we don't think about, types of risks and categories of risks that we're not thinking about, and we should be. And so I don't want to ruin it by giving any examples, but listen for that segment of the show because it was just really, really good.
Yeah, as real estate investors, we can't just always just stick within our lane. Sometimes we have to look to diversify a little bit outside of that asset class too. So without further ado, we'd like to welcome Anil and MC to the program. Well, guys, appreciate you joining us for another edition of Drunk Real Estate here. We have MC, Anil, and of course my babysitter, Jay, to keep an eye on me here.
Your handler.
Yeah, exactly. So MC, why don't you give a little short intro and tell us a little about yourself and what you're drinking, more importantly.
Well, appreciate you guys having me here. This is great. My name is MC Laubscher. So I have a digital media company called Cashflow Ninja. We started out as a podcast, and we're now a full education company. And then I also have several other business ventures, one in the insurance. I know we're not supposed to talk about it, but one in the insurance industry and another one in the capital space. And what I'm having is a tasty beverage. It's a tequila club soda with some lime juice.
Nice. Very.
I want to
very-
know who told you you're not allowed to talk about insurance.
Yeah. Well, we can.
Is this like an FEC rule here? Like,
I think it was in the interest of keeping the podcast audience interested. The insurance topic there.
Well, actually, the insurance that MC does is actually quite interesting. But well, it would take us a while to convince people of that. Anil, why don't you tell us a little bit about yourself?
Hi, I'm Anil Dham. I'm been an investor for almost 22 years now. In my life, I've done quite a few things. I've done everything from regular single-family house renovations, fix and flips, owning apartment buildings, private lending, and investing in small companies, small startups. And the other role I currently have, I'm also Borough president of Royersford Borough, which is a town outside of King of Prussia in the area. And I got involved because I was tired of seeing not enough things happening in the real estate world there. Like the commercial stuff was dying, and I thought I could help to revive it. And we've seen quite a renovation and revitalization in our town. So that's kind of my other passion.
So if I get enough drinks in you, then I can put an application for a new apartment complex.
There you go. And I am drinking a Moscow Mule, very simple, a simple, elegant cold drink on a nice evening.
Awesome. Well, appreciate you guys coming out. No one really wants to hear about Jay. He does enough podcasts, and
I don't get to introduce myself.
You can if you want.
Well, yeah.
I don't think anyone cares.
Fun fact about me: I was the original voice of Charlie Brown back in the 1960s. A lot of people probably know me from my early work.
Well, that's definitely more interesting than your actual life. What are you drinking over there? Anyway?
I am drinking a local brewery wheat beer. I forget the name of the brewery, but
it was Trogs or something. Wasn't
Trogs. That's
Trogs,
exactly what it
Trogs.
was. Yeah, it was that or Blue Moon. So decided to go for the local.
Yeah, we're at a local bar here actually to us, and they have all the different local beers on tap, and it used to be one of my old stomping grounds. So it's a little bit of nostalgia coming in here. But yeah, so as far as what to talk about today, you're hearing a lot in the media, in real estate spheres. You're hearing the word diversification all the time, and a lot of people are going to want to think that diversification just means stock market, like stocks, bonds, real estate investment trust or something like that. But being real estate focused, it means much different to us, and it's when we talk about diversification, there's many different ways of talking about it. Can we talk about locally versus investing away from home, across different real estate? That's my alarm system back home. Across different real estate spheres, if we want to talk about commercial, residential. So I want to touch on a little bit of diversification outside of the stock market. What you guys are seeing, what you're in these kind of uncertain times, what you're doing to diversify either within real estate or outside of real estate. And why don't we start with you?
Sure. So Kyle, thanks for that. So I think diversification within real estate is very important to do. For instance, I have a lot of my eggs in one basket of the town that I live in and the surrounding towns, but I also believe, there's this whole thing called the donut hole effect where city properties are not appreciating at the same rate that suburban properties are. So if you're a person who invests in cities, you should really start looking at investing in suburban areas because a lot of the commercial stuff is starting to move out of cities, especially with now people working from home. And the suburbs are really benefiting tremendously from that. So if you're a person who has stuff in cities, you may want to start looking into suburbs. As far as what diversification goes, that's a great question. I like cash. I know a lot of people don't, but cash gives you a lot of options. You have a lot of places you can put it these days. The bonds are paying great interest right now, and I bonds you're paying like close to 7%, and even just your regular municipal bonds are paying a decent return. So if you have money sitting around while you're waiting for a deal, there's definitely some options out there. But within real estate itself, I'm looking at a lot of small mixed-use properties that have like a storefront on the bottom and apartments above as a way to diversify from just doing traditional fix and flips.
Nice. What are you seeing?
Yeah, so I think like the first question you have to ask yourself when you hear diversification is why, right? So I always take a step back and I always write down questions when I hear a concept or something. Well, why? Why do I need to diversify? So if you look at what's going on in the marketplace right now, this is kind of my take. And the side joke is you never ask the South African what he actually thinks about something, because the chances are pretty good he's going to tell you. But so why? Because there's a lot of uncertainty, there's a lot of disruption, so there's a lot of fear in the marketplace, and then there's a lot of greed. So then you look at, okay, well, what does diversification accomplish? And essentially, it's a method to manage risk, right? So instead of having all of your eggs in one basket, you now look at different ways of positioning capital so that you can manage, all four seasons. People listening to this might be familiar with Ray Dalio and his books. He talks about the 4-season portfolio, and this is just stocks, right? That basically in any type of market situation, your portfolio is going to be stabilized, and the one part of your portfolio kind of provides a stabilizing factor to the other part that gets hit. So when you look at risk management, this is kind of the lens that I use. So there's a couple of risks out there for people. Some people are familiar with the economy, right? They go, well, there's risk in the economy. Okay, great. There's risk in the marketplace. So like in a specific market, there can be risk. And then recently, especially in the crypto world, folks have started to realize that there's a different type of risk. It's called counterparty risk, institutional risk. So you could be right about a lot of things, but if your money's in the wrong place, you lose it. So for example, there were folks on, FTX this year was a big story in crypto, the platform essentially collapsing and going bankrupt. There were folks on there, people using that platform because it was so good for traders that were shorting a lot of crypto. So they were right in the part of the cycle, but they still lost all of their money because they didn't understand or looked at counterparty risk and essentially institutional risk. And then there's political risk too, right? Which a lot of people understand now with the world kind of being kind of off-killed. So diversification is like risk management. Those are like the lenses. And then you go, okay, well, how do I position capital to go through these filters? And the alternative asset class, there's a couple of things, that I look at. I look at hard assets during hard times. Precious metals plays a role for me, a gold, a silver. And then there's kind of a growth play in rare earth metals. Cash is great to have. This part of the market cycle, and then there's still a cash flow portfolio, and I would leave a part of it for asymmetric opportunities, because there's so much going on happening at the same time that there's just huge imbalances because of what's done politically through the world, because of what's done economically and the economic environment that central banks provide throughout the world, and what's happening in marketplaces and with institutions. So that's kind of how I look at diversification. Why? What does it mean, and kind of how to play it?
Yeah, there's a lot to unpack there. I don't even know which thread to pull on. I'm gonna go back to Anil a little bit, because his was a little bit more straightforward, and then maybe we'll come back to the.
I just had one less mule than him.
Yeah, I don't even want to start pulling on the FTX thread on that one either. But so since we're going to have a lot of real estate focused people listening to this, just because apparently people like listening to Jay talk about real estate. But so if we're talking about real estate specific, and somebody, it seems to be many real estate investors, once they get into real estate, that's kind of it, and they won't necessarily diversify outside of it, but they will maybe kind of stay within that space. They'll say, "Oh, I'm overexposed in single family rentals. I want to invest in some multifamily syndications, or I will do," and they'll kind of stay within that inside the real estate space. And well, you could just see what happened last year. There were certain spaces that did a lot better than others. You had something like the hospitality space. It was obviously did not very well, but then multifamily and industrial did very well. Office took a big hit. So someone who was kind of all in on the, the one space, but then if you had a bunch of single family rentals, the single family prices shot up, and then single family rentals, you also have that upside of the prices aren't necessarily just linked to the income. So when you're talking about these people who will kind of be all in on real estate, do you think that's diversifying within that is a good strategy, or kind of just pick one and that's good enough?
My thought, Kyle, is start by asking a banker. Bankers will be honest with you. If they see a lot of the same type of property on, let's say, for instance, you own 5 office buildings, they're going to think you're a bigger risk to their bank than if you have a broad array of stuff. Right now, banks would love to lend on anything that's multifamily. They would love to simple single-family real estate that makes sense. They will absolutely lend on. What they don't want to get involved in is office space right now, because office is considered risky. It's considered like, okay, everyone will be working from home. What are you going to do with your empty office building? They love, renovation projects where you can, repurpose. That's definitely something that they want to do, as long as it's towards something that they want to lend to. For instance, if you have a multifamily building, no one will lend to you to convert it to offices, no matter what. You're not going to find any lender that's going to do that. But you got the reverse of it. I think you'll definitely see a lot of lenders would tell you they would be interested in that.
And you're seeing it a lot in some major cities,
Absolutely.
New York, and we're in Houston. You're seeing that happen.
Yep.
Jay, you're uncharacteristically quiet over there.
No, this is great, and so I guess my thoughts are, and I don't have anything tremendously new to add, but when I think about risk, it's exactly as MC said. Or when I think about diversification, why do we diversify? It's to mitigate risk, and when I think about risk, I tend to think at 4 different levels, and I think MC hit on 3 of those. Like the highest level, let's call it number 4, is that economic and political risk. So that big overarching risk that none of us have any control over for the most part. I mean, maybe you're part of the global elite, pulling levers behind the scenes, but
back room of the pizza shop.
Yeah. But I don't think any of us kind of have any control over that level 4. And then you go down one level, and it's kind of that market location risk. And so like we invest in Houston, so we have risk of hurricanes, and we have risk of other things in Houston, oil risk. And I live in Florida, I have weather risk. And if you live, whatever, you have the market
which you claimed 6 months ago. I did the math that the Gulf side of Florida never gets hit with hurricanes. I'm never going to let you live it down.
I am a hurricane denier. And so that's that kind of the level 3, and then MC mentioned kind of the level 1, the counterparty risk. I often refer to as the team risk. So Oftentimes you're investing with somebody, and you're either entrusting them to manage the asset for you, or maybe just like with FTX, they're not managing the asset necessarily, but they're managing your money. And they're stewards, custodians of your money. And then there's a level 2 in there that I think we need to talk about as well, and that's the actual asset risk. So in real estate, that might be you buy a property, well, there's a foundation issue that you don't know about, or there's old wiring that results in a fire, or you invest in the stock market and you don't know that Microsoft is getting ready to get sued again by the DOJ or whatever it is. There's that potential asset risk. So I kind of think in terms of those 4 layers of risk, like biggest down to smallest. But when we talk about is real estate an asset class, I don't think of real estate as an asset class any more than I think of the stock market as an asset class. And I know a lot of people think of the stock market as an asset class, but anybody that really diversifies in the stock market knows that you don't think about the stock market. You think about large cap stocks and mid cap stocks and small cap stocks and growth stocks and emerging markets and this and that. And there's all different ways to diversify. And so I think if we think of real estate as kind of this one homogenous asset class, we lose the value of diversification, because office space is a whole lot different than retail space. A lot of people will plug notes into that idea of real estate, but notes is more like the stock market than it is real estate. And so I think we really have to look at every sub niche or every niche within real estate as its own asset class. And then within that asset class, whether again, it's multifamily or single family or commercial or office or retail or warehouse or notes or whatever it is, we have to look at those 4 layers of risk.
So So if you're looking at it that way, then can you say, like, the same way that a stock market investor says I'm diversified, but when they say that I'm diversified, I have, I'm in a tech ETF, a large cap ETF, a small cap ETF, a bond ETF, and maybe a international ETF, and say that I'm diversified. Can you look at the non-asset class of real estate and be diversified enough just within that space?
I think everything Jay said, I absolutely 100% agree. I think one thing that most investors don't do is they don't stress test their asset class and their assets enough. They don't have another person look at their stuff and say, hey, what are my risks here? Everyone's like, well, I'm an investor. I fix and flip houses, and that's all they do. And they don't have anybody else looking at that. So I think one of the best ways you can diversify, to talk about diversification, is have a banker look at it, have a financial planner look at it, have somebody who's not 100% involved in just say real estate, look at all the risks that Jay just mentioned, because they're out there, and most people don't even bother to take the time to do that.
Yeah, and there are other ways to diversify. I mean, there's so many different ways to slice and dice. I mean, one way that we often talk about in our business that doesn't get talked about a lot is, where are you in this thing called the capital stack?
Yep.
So lending money has a lot lower risk than being a passive investor that kind of gets paid last. If you're the lender and you get paid first in a deal, that's a whole lot less risky than a passive investor that gets paid last. And then there are levels in the middle where you can get paid before the last, after the first. And so you can diversify where you are in the capital stack and when you get paid. And the thing I think a lot of people have to realize is that with diversification, you're smoothing out the risk, but you're also smoothing out the returns. And so a lot of people, they don't like diversification because when they hear the word diversification, they think, I'm not going to make a ton of money. And it's true. I mean, you're not going to hit that home run where you make 1,000 times your money when you're diversified, because there may be a couple deals that you do really well on. But if you're well diversified, you're probably going to have a bunch of deals at the bottom that you don't do well on. It kind of smooths that out as well. And so diversification, in my experience, tends to be very popular with the more sophisticated, the investors that have been doing this for longer, who aren't out chasing the big wins. They're the turtle. They're the slow and steady wins the race. And that, to me, is the value of diversification, especially in a market like this where we don't know where things are going to be a month from now or 6 months from now or 2 years from now.
Yeah.
It's the whole reason that stock market has options, right? Like when you talk about traders, like they'll make a big bet on something, but they'll put options on it, and you're not. It's whether it's good or bad, and when I started this saying we don't want to talk about the stock market, but whether it's good or bad, we've seen a real dumbing down of investing generally across all asset classes. So if you look at the stock market, there's all ETFs right now. So you could bet on sections of the market instead of actually having to pick stocks. I can't even name somebody who someone will say, oh, I like Apple or I like Google, or the FANG stocks, as they call them. Like they'll invest in something like that. But as far as actually picking stocks and looking at PE ratios and stuff like that, I don't know anybody who does that anymore. And when you look at the options now with real estate, like you can literally pick an operator and just give your money to them, and they will do all the work, and they'll renovate a multifamily unit, or they'll essentially allow you to invest in something without you having to do the work. And so I think, to your point, it's people are getting lazy in that, at some point you have to trust the operator. When you get into the stock market, obviously you have no other choice. You're not going to be able to call them up and be like, show me all this, show me this. But at some point you have to trust the operator, but there is some low level due diligence that everyone should be doing that I just think, people have gotten a little bit complacent and aren't really doing anymore.
And it's not just trusting the operator, because most operators are going to invest in a bunch of different things, and some things are going to be higher risk than other things. I mean, when I invest in stuff, I trust myself. I think I make good decisions, but that doesn't mean everything I invest in is low risk. Sometimes I invest in higher risk stuff, but I go in with this attitude that I realize, I could lose all my money in this deal. I could lose 50% of my money in this deal. And so, while there's a big component of trusting the operator. You also have to talk to the operator to figure out for this particular investment or this class of investments or this fund of investments, what type of risk are they looking for relative to the level of returns? Because remember, risk and return are intricately related. They're correlated, and more risk, the more potential upside, but also the more potential downside. And so it's not just trusting the operator, but it's also knowing what level of risk they're planning to take on a particular investment, because even the best investors in the world sometimes do high risk things on purpose where there's a big chance of losing money. And so you have to know what their goals are with a particular investment, not just trusting them.
Yeah, I'm glad you brought that up because it's as I said, we discussed it, but it's also one of those things where we someone like Joe Fairless, same space as us, does large multifamily properties. We were interested in investing in one of his funds, but we felt like we're very obviously exposed with our own investments. So my wife and I talked about it, and he had an option of basically coming in higher on the capital stack. So there was, there's the primary debt, and then there was like kind of a pref equity point. And to Jay's point, the common investor that was the lowest on the capital stack, it was, I forget, it was mid-teens or something they're projecting as far as an annual return, and the higher in the capital stack was 9%. And so there's a pretty big delta there. You're talking about maybe a 5% delta, but as far as diversifying ourselves out of that, we felt much more comfortable investing in that because, the not knowing what the uncertainty in the world and everything is going, you talk about all those risks that you guys are, at the top with political and everything, not knowing where that's going, then even if this investment over here doesn't do as well, this one we still should get the 9%, even if, it doesn't do so well.
Is Joe the sponsor of this show and I wasn't told? Is he
is
he funneling you some swag?
Either that or Anil's going to pitch some banker at the end because he keeps saying to talk to a banker. I don't know if he's going to say.
Well, I always say that because bankers are really honest and they will tell you, hey, it's too risky for us. That's my main crux with that. Is like a good banker who's done a lot of these loans will say, hey, we got in trouble with guys like you before, or when you're too heavy to one thing and not heavy enough on cash, we don't like to lend to that. So that kind of acts as a brake to somebody speeding down the road of making a bad investment.
So they're basically underwriting deals differently at this part of the cycle. I think that's a big takeaway if you're listening and watching this, is like at different parts of the cycle, you have to do different things. You can't do the same thing throughout the cycle, and we've had one heck of a run, economic run since 2011, 2012. We've had a very, very good run. So now it's almost like, to bring in the sports analogy, because we're in a hockey bar, you got to bring it in there. You got to play some good red zone defense. You got to play really good defense this part of the cycle, and that's why, a lot of people are talking about diversification. So I think if you don't know anything about an asset class, then diversifying it could also be the worst thing that you've ever done. For example, a lot of folks are talking about oil and gas deals, right? Now, if you don't know anything about oil and gas and you just blindly invest now in the oil and gas space because you're diversifying, and all the cool kids are doing it, that's probably not the right move too. So it's like what the control over the investor, because that's also a risk. From a risk management standpoint, knowledge base, like what do you know? What are you comfortable with? Know and understand that it's different now than it was in 2013. So what can you do different? And if you don't have a huge knowledge and you're very focused just on the real estate side, maybe you're heavier in cash, and that's your diversification strategy in a safe place, right? Spread over a number of banks, insurance companies, under your pillow, mattress.
I want to go back to something Anil just said, which is about bankers, and I hate bankers. But let me tell you something. He's
had different experience, apparently.
Yeah, no, I don't really hate bankers. But I think for those who want to de-risk, one of the best ways to do that is to form relationships with local bankers and local lenders. It doesn't even have to be a banker. It could be a hard money lender, portfolio lender, because especially in times like this, those that are closest to the market, the ones that have been lending and have lent through 2008 or previous cycles, not only do they understand the economy, that level 4 risk, but they also know if they're local, they know that level 3 risk. They know the local market. And so I'm a big fan of, even if I'm not going to get a loan from a hard money lender or a small local bank, a portfolio lender, I might take a deal to a hard money lender or a small local bank if I don't know the area really well. Because if they say to me, I'm not going to loan on this, I get to say, well, why not? And they're going to say, well, I remember back in 2008, there wasn't a lot of economic diversity in that part of town. And when the market dropped, that part of town, everybody moved closer to the city and blah, blah, whatever it is. And so they know something about that market based on previous cycles that they've been through that I would never know. And if I'd gone to a national lender's not going to know that about my market. And so you just get a lot more insight, again, not just into that level 4 risk, but that level 3 risk. And if you find a lender that's accustomed to lending on fix and flips or accustomed to lending on rental properties, well, they might be able to get you help with that level 2 risk, the actual property and asset risk. And so, yeah, local lenders and local bankers are fantastic, especially during this part of the market cycle, just helping you de-risk.
And they also, the one thing that bankers talk to other bankers, and they'll all tell you who is struggling to make payments and what type of asset classes are struggling to, be on time and or going into foreclosure. That's usually they're one of the best resources to find out what's happening in their marketplace, because they see the numbers first.
So taking a sphere of, this is kind of a real estate show, and MC, you made the point of, you might want to not want to go into oil and gas as something to diversify if you don't know. What would you say is a good dip the toe in the water, like next step for someone who is comfortable with real estate, has invested in real estate their whole life, of other asset classes or places to go if they want to start exploring other outside the stock market places, to put their money?
I'll just share what I do.
That's that's actually, I love it when people do that, because instead of speculating what people should do, let's hear what people actually do.
When I try something new, I immerse myself into it for like 6 months, sometimes 12 months. So crypto, when I looked at doing stuff there and invest in certain businesses in that space, I didn't just say, okay, well, all the cool kids are doing this, let's jump in here. let's get in. It's going to the moon. Can I be a moon boy too? No. So I basically try to learn everything that I can about the industry. I followed some influential people in the industry that are pretty close to where everything is going. Followed them. There's some people that I read their books. I listen to podcasts, all that kind of stuff. So 6 to 12 months, I feel like I have a pretty good understanding. After immersing myself in this, I have a pretty good understanding. I kind of see where there might be opportunity, where the majority of folks might not see the opportunity. Not just using that example. And the reason why I'm sharing that is that's just one of the last ones that I really immersed myself in. Not just buying a coin and hoping it goes up, but investing in a business that's delivering a value in the marketplace that can survive up, down, and sideways kind of movements in the marketplace. So that's what I would do. I would find an asset class that you're interested in, that you like, that you want to kind of dip the toe in, and invest in your knowledge base first before you invest any money in there. And then start small. It doesn't have to be big moves that you make. That's just what I do. That's with my risk profile. Everyone's different. Everybody goes about it a different way, but I can't give advice if I haven't done it personally. So that's what I do.
So yeah, I think this is a really good time to bring up like kind of what two great examples that I think MC gave. And we recognize as real estate investors in the real estate world, we don't talk about real estate as this homogenous thing. We recognize that there are lots of different asset classes in real estate. There's lots of different ways to invest in real estate. You can invest in office, you can invest in notes, you can invest in multifamily, you can invest in real estate. But people outside of real estate, they hear real estate, they think, okay, I want to invest in real estate. And they don't recognize that there are all these different ways that are obvious to us. Well, it's the same way in every other asset class. So you mentioned oil and gas. Oil and gas, I know personally a half dozen different ways to invest in oil and gas.
Yep.
You may be investing in the extraction. You may be investing in the equipment and getting depreciation and tax benefits. You may be investing in the land where the oil is being extracted from. And so and I'm guessing there are probably a half dozen or a dozen more business models that I'm not even familiar with. But if you're involved in that space, you recognize that oil and gas isn't this homogenous thing. It's this broad range of sub asset classes. Same in crypto.
Yep.
So we talk about, I mean, you ask the average person on the street and they say, oh, I don't invest in crypto. I don't trust Bitcoin. And my personal experience, the day my son started singing the Dogecoin to the moon song, I knew it was probably a good time to get off that train. But that doesn't mean there aren't other niches within crypto. Just like you said, I invest in the equity in some of these companies because I believe in what they're doing long term. It's not just, when we talk crypto, it's not necessarily just cryptocurrency. It's not just these coins that we trade as currency, but there are other things that we can be doing with blockchain and with tokenization, with fractionalization, and all these words that most people don't even know they exist. But
Right.
once you dig into crypto and blockchain, you realize there's 2 or 4 or 6 or 10 different ways to invest in crypto. And I'm guessing with any other major asset class, all the ones that I'm not knowledgeable enough to talk about, if you dig in, there's probably at least a half dozen different ways to invest in that asset class. And each one comes with a different risk profile. And if you can invest in different ways, you're diversifying. And so just like you said, anytime you're going to be looking at a new asset class, start to really investigate what are the different ways to invest, what are the different benefits, because only at that point do you really understand how to diversify. It's not just diversifying, do I invest in Dogecoin versus Bitcoin versus Ethereum, but it's all the different actual business models within that asset class that you can invest through.
Yeah. Now, to your point, for example, in that space, just to give an example of businesses in that space, is there are folks starting tax companies servicing the crypto space. Now, do you think with 87,000 IRS agents, they're going to sit around or go, wow, there might be a lot of taxes we can collect there? So those guys are going to do well regardless of what happens in the market. The same with like estate planning. How do you leave a coin to a child or a grandchild? I don't know, but somebody's figuring it out and starting a business. The other thing that I also wanted to share, because this is also kind of a hot topic in diversification, was I see a lot of people promoting buying businesses, and they're selling courses buying businesses. That's the same. I would take the exact same approach to that. Having started several, I haven't bought any. So if I had to go and buy a business now, I would immerse myself into that kind of stuff, follow folks that have done it, learn from folks that have done it, listen to podcasts, and then eventually do something, but not just blindly, go buy a business. Because it's supposed the thing that you have to do now all of a sudden, right?
And just to add what MC was saying earlier about what he's actually doing and what I'm actually doing to diversify risk. Number one, I believe in syndications, especially outside of your local market. I'm involved in one. I'm looking at others, constantly looking at others. I've been in like 4 other syndications. All have done really well. I think that's a good way of mitigating the geographic risk and asset class risk a little bit, being that these are larger multifamilies than what I own, which are smaller multifamilies. The other thing I do is a lot of private lending to home builders, to small home builders who are doing 1 or 2 houses at a time. And I know their product. They always sell because their stuff is top-notch quality, and people will bid up for that. So I have no problem doing a private loan to a home builder, knowing that it's going to take 6 to 12 months for the deal to complete. And the third thing is I invest, my background is I'm a physical therapist, and I'm currently investing in a small medical device company that is fulfilling a niche that the industry has missed. So I happily gave him a check to invest in his, own 1% of his company privately. And in 5 years, he hopes they, get bought out. And I think he has a fairly good chance of doing that.
Yeah, that's interesting. I was listening to actually Jim Rogers today, and he was making a comment about how
Is that Mr. Rogers? I thought he was dead.
no, that was his dad.
Oh, Jim Neighbors. Jim Neighbors, the Gomer Pyle guy.
No, so and he was talking about to your point, investing in or what right, and where people get in trouble is when they go outside their sphere of knowledge and they try to the shiny object syndrome and trying to go into different asset classes and things like that. And I loved your answer with just because you're in real estate, you're going to have that knowledge about lending. You've worked with bankers, you've had to get loans yourself, and you're going to know how that space works. So it's not that big of a leap for you to take the other side of it. Let's, let me lend some money to somebody, or to, I do small multifamily. I'm going to invest with a large multifamily syndication because, yes, it's a little bit different. There's more moving parts, but the fundamentals are still there. But let's talk about, okay, if we are going to go outside the real estate space and we are going to look at other possible diversification asset classes, things like that, is there anything that you guys are liking right now? Like, are you big on, precious metals, or we brought up crypto a few times, or, is there, or buying businesses, or, I don't know if I would do medical devices because I don't know anything about it, but, or
Your YouTube history says otherwise.
yeah. But is there anything that you guys would recommend, especially for someone who's maybe been in real estate their whole life, other asset classes that they should look at?
Yeah. So you mentioned precious metals. One of the things that folks have to ask themselves too is, what do you have and why do you have it and what do you want it to do for you? So in times of uncertainty, in times of where there's a lot of fear and disruption and that kind of stuff, folks go to things that they're familiar with, that have stood the test of time. That's wealth insurance. So precious metals doesn't provide cash flow, gold and silver, but it's essentially insurance for a catastrophic event, whether it be politically, economically.
There's no risk of that these days.
Yeah, exactly. So you know why you have it. So it's great to have that in your portfolio. And for me, I grew up in South Africa, so and my degree is in history and economics. So a lot of economics was about physical mining, the mining industry, which is huge in South Africa, whether it be gold mining, diamond mining, platinum. I mean, there's so many platinum highways. I took my wife on a safari out there. You drive down the highways and just see platinum mines. They literally call it Platinum Highway.
I hear some people have gotten really rich with emerald mines.
Yep, that too.
Robert Kiyosaki does a lot with precious metal mining too, doesn't he?
Yes, the elongated muskiness.
Yep.
Yeah, so know where you have it. That's wealth insurance, and then cash is great. Other asset classes. So cash flow. What does your cash flow portfolio look like? So you could be cash flowing in businesses. You could be cash flowing different niches of real estate. There's different, and of course you can position yourself in businesses with asymmetric opportunities because of what the market is providing right now.
Whoa, big word there. This is an important word. What do you mean by asymmetric opportunities?
So it's imbalanced. Something is not symmetric, it's asymmetric. So it's kind of distorted. It's tilted the scale is tilted the one way. That's how I understand it.
Home run opportunities.
Right? Yeah. So it's something where the market is literally distorted it so much, either from a policy standpoint or a political standpoint, that if you position yourself there, it could be a huge home run. So like, for example, one of the stuff that I've read a lot about and looked into is a lot of the green energy initiatives, the carbon credit kind of market. Lots of asymmetric opportunities there because of the political and the kind of the economic environment. The same with oil and gas. Funnily enough, there's opportunities in both because it's so distorted. So there's a lot of those types of opportunities where you can position yourself and have home runs because it's so out of whack, essentially.
And everything you said is great. One of the things with precious metals, you said it perfectly, that it's almost like a forced savings account. It's wealth preservation. If you own a gold bar that's worth $1,700 or $1,800 right now, you can't go out and spend it. It's hard to find somebody who's going to give you that. You'd have to actually make an effort to cash it out and then go spend it. So precious metals is good for forcing you out of making bad decisions, I like to say. But the other thing I think that I like right now is I like bonds. Like bonds, everyone should have an I bond. They're 10,000. You're only allowed 10,000 a year, but every one of your LLCs can have an I bond as well. So you have multiple LLCs, you can sock away a lot of money that's state and federal, state and local tax free, and you're earning 7% interest right now. It to me
was 9 the last.
It was 9, but it's 7% and not pay taxes on it. That has that increases the return on it even further. I think that's just a very simple, easy investment for most people that are listening to do. And if you're in real estate, you have multiple LLCs and you have a lot of money sitting in cash, put it in it.
That's great. Well, we're getting to that point where we had some good feedback on the last podcast of people play, the drinking games at the end. So a popular drinking game is the F, marry, kill, where you got to pick one to F, one to marry, and one to kill. And so to go along those lines, and since we're talking about diversification, so if you had $1 million and invest in the stock market, $1 million invested in precious metals, or $1 million invested in crypto, which one would you F, which one would you marry, and which one would you kill?
Well, I guess crypto would be the F. And then I guess the marry would be the precious metals. And what's the other one? The stock market is the
stock market is the last one. You kill that?
Yeah.
I think I'm the reverse. I'd kill the crypto thing and I'd F the stock market, and that'd be my answer.
What is F again?
Are we
Fornicate.
are we trying to do? Are we going to make our
Fornicate,
Dave, our podcast guy, bleep it out for that?
I think our audience can probably figure it out. Look it up if you can't figure it out. So I think maybe I'm overthinking this, but I think I'd marry the stock market. Because I think of stock market investing as that long-term investment. And I think of marriage as, unlike my wife, as the long-term commitment. I mean, she thinks of it as long-term commitment, just not with me. But so, yeah. So
Sorry, she's not going to listen to this, so don't worry about it.
No, it's funny. I made a comment about her in a previous episode, and she actually did listen to it, and she came back and she punched me in the arm.
They always hear their name.
They always hear the name. So marry stock market, and then I'd probably kill precious metals if I had to. Don't get me wrong. I have precious metals in my portfolio. I like precious metals, but I think of them more as a hedge than an investment. They're diversification to reduce downside risk. And then crypto, I love crypto, but like we were speaking earlier, when I think crypto, I'm not investing these days I started investing in Bitcoin in 2015. So I'm not going to claim I've never been a crypto fan. But I'm not investing in Bitcoin or Ethereum or any other coins these days, but I still love blockchain, which is just in my little world.
That wasn't the question, though, Jay. The question was sorry. Apparently, you're like my wife. I have to specify more. And when I say invest in crypto, I mean crypto coins.
Oh, and then I'm going to kill the crypto coins, and I'll.
I didn't say blockchain. I like the blockchain technology.
Okay, well, so yeah, I'm not a fan of cryptocurrency right now. I don't see the intrinsic value, and I'm not saying that there aren't going to be one or two coins that don't rise to prominence if they gain traction with either governments or banking regulation or other areas where they get widely adopted and governments and organizations start creating standards around them. But I'm not going to try and guess which one or two of those it's going to be.
I'm just going to add to the comments here. In 10 years, 15 years, pretty much 100% guaranteed the stock market's around. Pretty much guaranteed real estate market's around. Can't say that about cryptocurrency.
Well, that's why you have the three different levels here. You have the short-term commitment, you have the marriage, and then you have the one that you just get rid of. So I might be a little bit emotional about this because two of those three have screwed me in the last 6 months, not in the fun way. Where I invested in a crypto mining fund when crypto was at 40, or the Bitcoin was at 44,000, and now it's at 16,000. So that didn't go well, or it's not going well. And then gold, I don't regret investing in gold when I did. I invested it when it was 2,000. But that was also when there was a significant chance of Russia nuking us. That had just all kind of happened.
Significant chance.
So, okay, sorry. It depends on your definition.
95% chance of nuclear war.
When I consider more than
More of a
zero
risk.
a significant
Fair
chance
enough.
when you're talking about nukes.
Fair enough.
And so that was happening. So I went out and I bought a bunch of physical gold. And I look at it.
because when we all get nuked, the gold's going to be really
It'll
really
protect us.
important.
You'll hold the
Yes.
coin.
Yeah, exactly. It's going to shield us.
Just the uncertainty in the world, to MC's point, people like to rush to what they know, and I looked at it as more of an insurance policy. It's an insurance against, but I also think there's a long-term, this is a whole nother discussion. There is a long-term issue possibly brewing with the U.S. currency as well. It worked the other way right now. So the reason that gold is down to 1650 or whatever it is now is because the U.S. dollar has been so powerful. If you look at gold versus other currencies, gold actually did quite well. So when I look at all of those, I didn't have anything in the stock market. I got out of the stock market 2019. That is I look like an idiot with the gold and the Bitcoin, but the stock market I did okay. So that's the long way of me saying that I would I'd probably marry the gold. I think there's a lot of long-term opportunity there. I'd probably F the Bitcoin because I don't think it's going down. I think it's only going up.
It
and
F'd you, now you're going to F it.
Yeah, exactly. And then I would kill the stock market because I don't know. I just don't like the fundamentals of it.
No way that's sticking around.
Can I explain my answers too?
Of course, yeah. That's
So I said I would marry the gold because it's been around. It's 2,000 years, 3,000. How long? It's
Long
been
marriage.
Yeah, it's probably going to be here for another 3,000 years. And then I said I would F crypto because how do you make money in crypto? It's a pump and dump, right? And then of course this
literally or figuratively depends.
It literally is. And then of course the stock market is the one I would kill just because again that's not my forte, my speciality, so I just kind of stay away from it.
It's funny that when you talk about people like real estate people, that I don't know a lot of people in real estate who are heavy into the stock market. It's kind of one of those real estate people don't really like other people
They don't like other people controlling their own
Right,
money.
exactly.
That's what.
Awesome. Well, hey guys, this has been great. I really appreciate you coming out. I think we had some great discussion. I took a little bit off the rails at the end there, but
All good.
that might be the most entertaining thing for everyone. But yeah. So if you guys want to talk about where people can find more about you, MC, you had a lot of different things going on. I don't know if you want to plug every single thing that you got.
Cashflowninja.com.
Yeah.
That's it. That's over 900 podcast episodes and content. Everything that I do is there.
Awesome.
You can find me on LinkedIn or on Facebook. Anil Dham.
And you can listen to me on Charlie Brown Christmas from 1968. Wah, 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 wah.
All right, guys. Hey, appreciate you coming out. Thank you very much.
Thanks, guys.
Thanks.